Good morning again, and welcome to our morning briefing presented by the Washington County Chamber of Commerce. I'd like to thank our sponsors this morning, Crown Castle, the Meadows Casino, EQT, Bistecca Steakhouse, and Washington Financial Bank for supporting this great program this morning. This morning, we're featuring Mekael Teshome, who is the Vice President and Senior Regional Officer of the Pittsburgh Branch, the Federal Reserve Bank of Cleveland. Mekael, good morning to you.
Good morning, Jeff.
Thank you so much for joining us. We appreciate it, and also appreciate the suit and tie this morning, too. You look great.
Thank you. Thanks for having me, and just trying to be as normal as possible in these times.
Well, before we start, how are you holding up? Everything well?
Everything's well. Our staff is well adjusted to working from home. Everyone in my personal circle is healthy and well, so thanks for asking.
Well, that's good to hear. We hope you keep it that way as well.
Thank you.
Mekael, to start, about 2.5 months ago, you gave a great presentation to our members at our annual State of the Economy event. And during that event, you mentioned that you suspected, and the Federal Reserve was predicting, average growth for the region and for the country. Now, of course, no one could have saw the COVID-19 emergency coming, but how have you changed your outlook for the country's economy and the local economy since then?
Yes, it's amazing how much can change in 2.5 months. Just before I go any further, I have to give the standard disclaimer. Everything I say is my own views and not the official position of the Federal Reserve. I will say that keep in mind, forecasts are always uncertain, and they're unusually uncertain now because the economy is really going to follow the course of the virus and the success of the public health measures that we take. And that's beyond our control. There are a lot of unknown variables, such as when will we get the virus under control? Will there be additional outbreaks? And then on top of that, the data that we have on hand have yet to catch up with economic reality. Many of the reliable indicators we look at are really for March, late March, early April. And forecasts depend on models that use data. So there's a lot of uncertainty there. But with that said, I'll speak to the general contours of what forecasters in general are predicting for the general path of the economy. We just got first quarter GDP numbers. They showed that the economy contracted by 4.8% in the first quarter. Most of that was from late March. Prior in the fourth quarter, the economy grew about 2%. And then the early forward-looking indicators that we're getting now are showing record declines, and that tells us that the contraction in the second quarter will likely be in double digits.
Okay.
Really unlike anything we've seen before. And again, there's considerable uncertainty there. So the expectation is that this will be the worst quarter that we're in now. Then the next phase will be when the formal restrictions start to ease and they're slowly lifted, and we're starting to see that now. But it's going to happen in different parts of the economy at different rates. So it's really more like third quarter when we start to see activity really picking back up. In the second half of the year, we could see sizable growth rates just in nominal terms, but that's really only because the drop was so severe. But by the end of 2020, we're still likely to be still below pre-pandemic levels of activity. And then, looking a little bit beyond that in terms of specific growth rates, it's really hard to pin down. And the forecasts are changing very frequently. And that's because besides the public health aspect, the key uncertainties around the outlook revolve around consumers, for example. Even if things open up, it's not clear how comfortable consumers will be to go out and spend, and consumption is 2/3 of the economy. And then another uncertainty is that it's not clear what damage to the productive capacity of the economy will be when we get to the end of the crisis. And I'm thinking in terms of bankruptcies. How many firms will survive it? We don't really know that. And that has an impact not just for 2020, but also 2021 and beyond. And then there's also the global dimension. This is a global pandemic, global economic crisis. And part of our economic recovery will depend on how the rest of the world recovers. And we don't really know that yet. So the takeaway here is that it's a hard stop for the economy. It's going to be a slow recovery after that. And it's really unclear when we'll get back to pre-pandemic levels of activity.
One of the things for us here at the Chamber was basically the hard realization of how much of the economy is based on consumer spending. I mean, you always hear about it, but you don't really realize it until there's a pandemic or some emergency such as this. So I agree with you in terms of it's going to take some while for people to feel comfortable to go back out, to start feeling good about bringing in large crowds. And I think a lot of our businesses are starting to see and respond to that.
That's right.
Now, the Federal Reserve has been very active and being very proactive in working through and with companies during this pandemic. Would you mind explaining a little bit about what the Federal Reserve has been doing and some of the actions it's been taking to help our business community?
Sure, yes, there's been a lot of activity. Our district president, Loretta Mester, describes the aim of Fed actions in this crisis as building a bridge from where we were in February to where we would be after the virus's passed. So in order to do that, the Federal Reserve took a number of actions. The first thing it did is that it lowered the Fed funds rate from 1.5% down to zero almost immediately. And the Fed also provided forward guidance to markets saying that it expects to maintain this level of interest rates until it was very clear that the economy has weathered the events. Then, to ease financial conditions, the Fed has been purchasing large amounts of treasuries and mortgage-backed securities. Initially, it was announced that it would purchase up to $700 billion of these assets, but then it expanded the scope and left it open-ended. Also, to stabilize financial markets, the Fed ramped up its repurchase agreements and offered additional dollar liquidity to central banks around the world. And on top of that, the Fed then started to encourage banks to lend, and it did this by encouraging them to use their capital buffers to extend credit and assure them that there won't be adverse regulatory consequences down the road. And they've also encouraged banks to work with their customers to modify their loan terms as much as possible. And then perhaps more the media attention-getting aspects of it is that the Fed invoked emergency lending authority to support credit flow. And this was really done to mitigate the effects on the economy and to prevent the crisis from evolving into a financial crisis, much like the one we saw with the Great Recession when credit markets froze up. So credit has been extended. The Federal Reserve created a host of new facilities. These facilities include facilities to municipal governments, corporate bond markets, the commercial paper market, lending to small and mid-sized businesses. There are about 9 facilities that were created or expanded that combined have about more than $2 trillion worth of capacity. So there's been an expansion of support for extending credit. The Fed is constantly assessing the needs of the economy, and Chair Powell is committed to expanding and doing more if necessary, depending on how things evolve.
Good. Well, one of the interesting points you made back in February concerning manufacturing was, and you touched on it a little bit, was that it stabilized after the Great Recession back in 2008. However, I think a lot of this pandemic has pointed out our domestic reliance on overseas manufacturing. Do you feel now that we may see a renaissance in domestic manufacturing, as it has been pointed out to us several times that we may be a little over-reliant on foreign manufacturing and importing?
Yeah, you're absolutely right. The pandemic did create supply chain disruptions because the shutdowns were happening everywhere, really, domestically and overseas. And so many manufacturers found themselves having to shuffle their supply chains around a lot. But I would say it's still a bit too early to say if there will be a renaissance in reshoring. We were seeing hints of that prior to the pandemic because of the U.S.-China trade war. There were even hints of that after 2011 with the earthquake and tsunami in Japan, but the process has been very slow. It's not a straightforward process to bring back production because domestic producers will still have to compete on price. And in some cases, producing here in the US could be more costly. And will customers be okay with that? It's really hard to say. And then also there's the fact that factories are reluctant to add capacity in excess of demand for their product. And right now, aside from medical supplies, demand for manufactured goods is fairly weak. And then there's also the long-standing issue with labor. Manufacturers prior to the pandemic were saying that they're having a hard time getting labor. So I would say that we could very well see pockets where there's growth in manufacturing production here in the US. I don't doubt that will happen, but and this will especially happen as manufacturers diversify their supply chains. But until the underlying cost structure for producing here in the US changes, I'm reluctant to say that we could have a renaissance. I think that those underlying market fundamentals really need to change before we see a big shift in.
That's a good analysis. And I want to go back to our question you had on labor and unemployment. But before I do, I want to remind our participants joining us this morning, you're welcome to ask questions. Mekael, you would have to go to your Q&A button near the bottom of your screen, submit your questions, and we will certainly ask them to him. Mekael, going back to, again, the labor market, we experience here pretty much in the region, in Washington County, and I think over the country, as you mentioned, a pretty tight labor market. Now we're seeing, weekly millions of people, unfortunately, being unemployed, trouble finding work, things of that nature. What are your thoughts, projections on unemployment and the labor market moving forward? And, how do you think the employment market will recover?
Right. The job market's recovery will really depend on the overall course of economic activity, which will in turn depend on how well the virus is contained. So it's not like flipping a switch where the government permits businesses to reopen and then everybody goes back to work. It's not quite like that. As with GDP, the biggest shock to the labor market is happening right about now, as you pointed out. Many forecasters are expecting the April unemployment rate to be between 15 and 20%. We'll get the official numbers tomorrow, actually. And then from there, the expectation is that it'll decline gradually. But by the end of the year, we could still see unemployment rates in the high single digits. So it's going to take an extended time for the unemployment rate to get back to its pre-pandemic levels because the overall pace of economic activity will take a long time to recover as well. Now, there are a few downside risks that make this outlook even more uncertain. First of all, the longer that the pandemic lasts, there's a risk that what were temporary layoffs could turn into permanent layoffs. This is a big risk that we're monitoring. We already, we've heard from large employers such as Boeing that they were planning to reduce their workforce by 16,000. Uber announced something similar. Also keep in mind, forecasts for auto sales are well below what they were from last year. So with all of these demand being slow to recover, there's that risk that those layoffs become permanent. So that's something to keep in mind. And then the second risk is that the longer people are out of work, the harder it could be for them to get back into the workforce. Their skills can erode over time. They'll lose touch with the labor market. There's no way to really predict how that will evolve, but those are the two big risks that we're looking at. So the takeaway really is that we can expect this to be an extended recovery period for the job market as it is for overall activity.
We've seen that here in the county as well. Most of our businesses, many of the businesses that are members of ours that we've talked to, have been proponents of a slower opening. They want to make sure they protect their employers, their employees, their customers, and those. But there is this misperception that you just flick on a switch and the economy goes back to normal and everyone's back. And I think your points are well taken, concerning that it is going to be a slower recovery than I think most people are thinking. And do you find that because of maybe that perception's out there, simply because how fast this all happened? Basically within a month or two, we had a complete shutdown. That may be that people think it's just going to come pick back up just as quick.
I think that's the expectation. Yeah, that's exactly right. People had this view that, well, it was a hard stop. The general view was that, well, we just need a month or two to kind of get through this, and then outlook slowly deteriorated from there. And then I'll just add one more thing. Just from conversations with a variety of different firms, I think some firms are now starting to think that maybe they don't need as many people at the same time. Mm-hmm. They're starting to figure out that they can do more work with what they have. And so I think there's that risk as well.
We could keep you on this topic for a minute. We had a great question that came in that said, what's the biggest challenge with reopening in business recovery that you see?
The biggest challenge truly is the public health dimension. Until it's clear that the virus is under control, you could legally open things up, but it doesn't mean people will feel comfortable going back to work. And, keep in mind, even before the public orders to close essential businesses, there were a lot of companies that were already starting to work from home and preparing for this before government response. So I think making sure that we have a lot of testing so that people know who's infected, who's not infected, whether or not there'll be a vaccine. Those types of public health measures are really what are going to give people the confidence that this is under control and they can go about their lives. Just opening up, I don't think is the answer.
So really it's all about consumer confidence and being comfortable getting back out into the market, shopping, and just going about daily life.
Exactly. It's about confidence and the measures to ensure we know what we need to know regarding the course of this virus.
Thank you. Back also in February, you mentioned or thought that inflation probably maybe creeping up, a little bit in 2020. That was before, of course, the pandemic. And now with the influx of cash and capital into the economy by the Fed, do you still see that moving forward? Do you still see inflation creeping up a little bit?
No, actually, we now have the opposite problem. Okay. So I don't see inflation accelerating anytime soon. The outlook, as you mentioned, for before the pandemic was for a slow rise in inflation as the tight job market lifts up wages, and that'll push inflation, but keep it close to about 2%. Now we have this enormous weakness in demand, which will prevent prices from rising much. Just think of a business that tries to raise its selling prices when there's so many unemployed out there. It's just hard to do. And on top of that, we have the collapse of energy prices, which will weigh on inflation. We already started to see inflation pressures soften in March, a little weaker than anticipated. And so over the course of the year, I would expect inflation pressures to remain muted rather than creeping back up.
Okay. Give me your perspective on the regional economy. here. You mentioned energy. That's something that's, of course, very important to Washington County. Banking, financial services, even gaming here in Washington County is very important to us. All that, of course, has come to a stop. Can you give us your perspective on the regional economy as a whole, how it's performing? We had a gentleman in a few weeks ago who mentioned that the sheer fact that our economy has become so diverse, we stand to weather this better than other areas of the country. Do you find that as well?
I completely agree with that gentleman, actually. So I'll just say we don't have much data on the regional economy yet. We have limited data on the macro economy, but regionally we don't have hard data yet for the most part. But the contours of how the economy evolves should be similar to the national economy. But as that gentleman pointed out, the magnitude is likely to be smaller. We have a diverse base, but also industries in healthcare, education, technology. These are the things that are more able to weather the storm than, say, other metro areas that have a big tourist presence, which is completely dependent on consumer spending and is probably one of the slower industries to recover. So I think we'll see what the data show in the next few weeks. It's still likely going to be a hard hit, but in terms of magnitude, I think we'll be in a better place just because of that diverse base that's not as cyclical or dependent on consumer spending.
Yeah, I agree with that as well. And the gentleman who mentioned that was Brandon Mendoza, the executive director of NAOP. I wanted to see if you agreed with him first before he mentioned that.
I'll have to give him a call and say Jeff called you out.
Well, I didn't want to call him out just in case you disagree. But,
No,
I had the green light, so to speak, when you agree with it. And we had another good question come in. Unemployed people who are at a minimum wage level are making more money with the current unemployment program. What incentives can the Fed provide to solve this, to get them back to work, things of that nature?
Sure, that is a concern that I've heard pop up. Are you still there, Jeff?
Yeah,
I lost your screen. Okay. Yes, that is a concern. I've heard from a number of folks. There is a little bit of that moral hazard issue there. But the thing to keep in mind is that this is these are temporary shutdowns. And so workers really didn't have an option to work, really. So the fact that the unemployment benefits are generous, I think, is not shouldn't be a deterrent for us because they're limited duration. As we reopen, then the incentives will go back to where they were before. They're not indefinite. So we should keep that in mind, that these were publicly imposed shutdowns. And in terms of the Fed, what it can do to incentivize workers, really that is going to be more on the federal government fiscal side. But what the Fed is trying to do is to ensure that firms have enough credit to be able to retain the workers they need to weather this pandemic. We need to build that bridge to when we really open up the economy. So the incentive really is for firms to be able to borrow, have enough cash that they can retain their workers to sustain them through the crisis.
Now, you mentioned too about small businesses, medium-sized businesses, and I wanted to touch on that point a little bit too for a second. Through the Triple P program, there's been a lot of discussion about larger corporations taking advantage of that versus smaller to mid-size small businesses that should be taking advantage of it, that need the assistance and need the help. I noticed that the Federal Reserve created I believe it's called the Main Street Lending Program. Yes. To do just that, to assist small to mid-sized businesses. Can you talk to us a little bit about that?
Sure, yeah, that's a great question. So the Main Street Lending Program was originally announced in March. It hasn't been launched yet, but we should get the word on that fairly soon. The program is really aimed for companies that are in the middle. And these are companies that don't have as easy of a time accessing capital markets, but maybe are a bit too big for small business loans. So these are, so the program is targeting firms that have less than 15,000 employees, less than $5 billion of revenue. That's a very broad range of firms, and that was by design so that we can capture as much of the market as possible. The basic design of these loans is that they'll be 4-year loans. The first year will be principal and interest will be deferred. The minimum is $500,000 for the loans. So not the smallest borrowers, but kind of in that middle range that perhaps missed out on PPP. And then the maximum will be up to $25 million, depending on the pre-existing debt load that the company had. The program is different from the PPP in that these are loans and they're not grants, which the PPP was. Mm-hmm. It's also not administered by the Small Business Administration. It'll be administered by the Fed, and firms that have already tapped into the PPP funds, they can be eligible for the Main Street funds as well. So it's really designed to kind of fill that gap of the in-betweens.
It sounds like a good program because, again, what we've been seeing here is, we have smaller businesses that, small to mid-sized companies that seems like it would target versus a larger program. And you did say it's a loan program. And can you maybe explain again for our participants what the terms would be?
Sure. Yes, it's a loan program. So there's, the PPP had a forgivable amount. The Main Street program does not have a forgivable amount. They're 4-year loans. So it would need to be repaid in 4 years. That first year is going to be principal and interest deferred. So primarily to get you through the next year or so through the pandemic. And then it's between $500,000 and $25 million. The interest rate on it is LIBOR plus 3%. So it's not the cheapest loan, but it's, as a backstop if you're really having trouble getting credit through normal channels. So I mean, those are the basic contours of the program.
Okay. We have one final question that came in. This is actually a great question. Are there lessons to be learned about the economy and how quickly it slid under during this crisis? And also, what could help fortify it when something like this would happen again? And that comes from our friend, John Berglund.
Oh, John. Yes, great guy. Thanks, John, for, I think we're out of time, right? Is that,
yeah, we just out of time. We'll have to catch up next time.
Yeah. So, the big lesson that we learned was that business resiliency really needs to be baked into the plans that firms have. And these can be costly, but they're really important. So contingency planning, focusing on resiliency and how to be flexible with how you work are really the key lessons that we're taking away from this. And they're going to come at a cost, really, because it's not cheap. So that's one lesson. I'd say another lesson we learned is that it's really important to have a well-capitalized, stable financial system. During the Great Recession, credit froze up, and that created the financial crisis that we had back then. But now the banks really, over the years, have built up adequate capital. They're really well capitalized. They have liquidity, and so the banks being strong from a capital perspective really enabled us to launch right in and start to provide all the support that we can. So financial stability is very important, which we've done a good job of. And then the second would be really working on business resiliency, supply chain, plans in case supply chains get disrupted, but they're going to come at a cost. And we should be okay with that down the road.
Okay. Well, that's the time we have for morning. Mekael Teshome, we certainly appreciate you being with us this morning and participating in this discussion. Your insights are always very timely and insightful. So we certainly appreciate you being with us this morning. So thank you again for being with us. Mekael Teshome, Vice President and Senior Regional Officer of the Pittsburgh Branch, the Federal Reserve Branch of Cleveland. I'd like to talk to you maybe next time about during the NFL season, how you and your Cleveland counterparts get along. But
Yeah.
thank you so much for being with us this morning.
Thank you for having me. My pleasure.
I'd also like to thank Crown Castle, the Meadows Casino, EQT, the Stecca Steakhouse, and Washington Financial Bank for supporting our program this morning. Our next discussion, our next webinar, will be next Thursday, May 14th, when we'll feature Joe McGinn and Chris Koop from Energy Transfer to talk about energy infrastructure in the nation and in our region. And also the day after that, on May 15th, we'll have our annual Municipal Leaders Roundtable, and that will be moderated by our State Senator, Cameron Baralotta. Thank you again for being with us this morning, and have a wonderful day.